Ladies and gentlemen, welcome back to the most bubblicious market that you have seen in a very long time. Nvidia is up 26% on the day. Microsoft is up 4%. The Nasdaq up 3%, and the S&P 500 up about 1%. At the same time, small cap stocks are getting absolutely obliterated today. AMC stock down 3.79%. What in the hell is going on here, and what do you need to know about this market as well as AMC stock? Ladies and gentlemen, let's dive straight into it. We all know what's going on. Nvidia earnings. We've talked about this many times, and I said this before Nvidia earnings. Nvidia would have a massive impact on this market, whether it was to the upside or to the downside. Happens to be Nvidia broke all expectations, and the record for the largest gain on earnings by market cap, gaining over $200 billion in 12 hours of value to Nvidia. Absolutely insane. They had great earnings. They gave great guidance. If they can follow through with that guidance, maybe that's another story. So we'll see. But as of right now, all mega cap tech is rallying. Like, it's insane. No regard for fundamentals. Fundamentals don't matter in this market. Who would ever thought that would have been the case after the Fed historically hiked interest rates at the fastest pace in history, and yet fundamentals don't matter? So kind of weird market we live in. Okay, let's put that out there first and foremost. So nothing is obviously a guarantee, and things are going to be very volatile. We heard last night that Fitch Rating Agency has put the United States credit rating, the AAA credit rating, on negative watch, meaning that any time now we could get downgraded. Now, last time we were downgraded, markets fell 6.5%. So I think there's a lot of potential for bad news here. Even if we do get a deal on the debt ceiling, which looks a little more likely today, it still could be brought with a negative reaction in the markets. Another thing that we have talked about here on this channel is the fact, if they do raise the debt limit, how much spending is cut from that. Part of the reason the markets are disregarding pure fundamentals is because the government's spending trillions and trillions of dollars a year. Stimulus checks are far from gone, but stimulus is nowhere close to being gone. The funny money is out there if you're a company, if you work with the government. So we'll see what happens with the final deal and the debt ceiling. What we're getting as far as news today, the headliner says debt ceiling talks enter crunch time as negotiators get closer to a deal. Key points. Negotiators move closer to a debt ceiling deal with just a week to go before the U.S. government faces a potential default. A warning from the Fitch Credit Rating Agency about U.S. debt added fresh urgency to the talks between the White House and congressional Republicans. Quote, "We're at a sensitive phase with sensitive issues that remain," said GOP Republican Patrick McHenry, one of the negotiators. Now, basically the tipping point is taxes and spending. We're getting weird headlines. Some are good, some sound bad. We even got a headline today that we could get a deal as soon as later today. And then we got other headlines that says, yeah, we're far off. And, key points are really holding this up. So we'll see how all of this shakes out. But again, it might be negative after the debt limit is actually raised. But again, we'll see. The markets can stay irrational longer than you can remain solvent, I think is a great quote for this market that we are in. Because, look at it. Russell 2000 down almost 1%. The Nasdaq is absolutely ripping. If you're looking at the QQQs, up almost 3% on the day. That's insane. Okay, so that's kind of what we're faced with today. We actually got negative economic data that came out this morning. Real estate stronger than expectations. The business activity in Kansas and Chicago with the PMIs was quite negative. So kind of bad news on the front of inflation. And markets obviously didn't care because Nvidia, it just went absolutely crazy. Now tomorrow, you're going to get at 8:30 in the morning the big data for this week. You're going to get durable goods orders month over month for April. You're expecting that at negative 1.1%. Last month's reading was 3.2% positive. So you're expecting a pretty decent fall here in durable goods orders. Core PCE price index month over month, expecting that at 0.3%. Last month's reading was again 0.3%. Personal spending month over month, you were expecting that to go to 0.3%. Last month's reading was 0%. Personal income, expecting that to go to 0.3%. Last month's reading was 0.3%. So overall, you're expecting decent spending, decent personal income, PCE or inflation to remain flat, and you're expecting durable goods orders to fall quite a bit from last month. So not really the best data expectations for tomorrow. Now, if we are better or worse than expectations, that's what's really gonna, move this market. And when I say that, that accounts for if AI stocks were to be flat, right? You might be bullish for quite a while now. The NASDAQ is completely breaking out. Again, fundamentals don't matter in 2023 to the algorithms, to the markets. Obviously, they should matter to you, and you shouldn't buy these stocks at all-time highs considering what's going on in the actual economy. But for right now, markets are just fine with that. Now, with the debt limit, that could be negative, with a potential downgrading of U.S. credit. These things will eventually have an impact on the markets. Now, the breadth of the markets, as you can see, if you're feeling pain in your portfolio, it's because the average stock is falling. Even though you're seeing these impressive gains on an index basis, markets are ripping, average stocks are falling. It's concentrated. Like I said, in the last videos, until you see AI stocks fall, which is again Nvidia, Google, Amazon, Apple, these large tech companies, once they fall, that's where the pressure really gets put on these short sellers. When these stocks are going up just to extreme degrees, there's not that much pressure on a margin call on a collateral basis to cover on these short positions. You could just ride out a short position even if that short position starts to go against you. And that's why I have a big problem accepting the data that we got today on AMC stock. Apparently, about 5% of the free float was covered on AMC. When AMC went up 3 days and then fell exponentially, right? We take a look at the reported short interest from the official reports. It dropped from almost 26% to 20.51%. It fell a lot. And the stock of AMC has also fallen a lot with very low volume. So I have a hard time believing that shorts actually covered on their short positions. It's possible, keep that in mind, but I think more or less they're just using the options to report that they did cover, and with using those options, they can also have a interest, right? They can have exposure to a downside move in AMC stock. But on the other hand, the other side of me thinks that maybe if shorts did really cover and this data is correct and it's not fraudulent, then maybe that is ultra bullish for AMC. Maybe that means we're probably going to get some good news out of this court date sometime soon. Because if shorts really did cover off of a 50-cent move higher from $5.50 per share to $6 per share, that caused shorts to cover, I mean, I think that would be pretty bullish, thinking over the next couple of weeks here. So on one hand, short interest still very high. When you account for the options, it's still well over 30% as per my calculations. Or on the other hand, if shorts did cover 5% of the free float, then I think that is very bullish for what's to come with AMC, because why are shorts covering when they are and have been so negative on the stock over the past couple of months? So I'll take either one of those, but it's weird. The data is definitely strange. Now, if we take a look at the overview from Ortex, a short score of 90, highest short score that you have seen in a long time with AMC. $526.41 million worth of short positions here on AMC. About 21% short interest of free float, 33.5% free float out on loan, 172.52 million shares currently out on loan. Days to cover at 6, cost to borrow at 58.32%. You also have 100% share utilization. If you take a look at the cost to borrow fees, Interactive Brokers has a 50% even cost to borrow fee with 900,000 shares that are currently available to be lent out. Now, cost to borrow average at 71.5%, cost to borrow max at 109%, cost to borrow minimum at 55.5%. So the numbers here still look very good, even considering short interest apparently dropped by that much. You're not really seeing the cost to borrow fees dropping upon that information, which again I think is pretty bullish. Now, AMC stock heading down into the close right now as the markets are ripping. This is really the story across the broad markets. Again, the average stock is falling while big tech is rising and is carrying the indexes here. A very weird phenomena, and it looks like fundamentals have all but been thrown in the garbage can. So there you have that. On a quick technical basis with AMC stock, like I said in the last video, $4.64 per share is the point in which we bounced back here on April 24th. That's the level that I would really be watching for next. Volume, again, another very low day, sitting at about 14 million shares that have traded hands. Accounting for the option activity, a lot of this move down that you are seeing has really come from the options, right? Those deep in the money puts that have been placed. A lot of those expire June 16th, and then a lot of them will be in July as well. So we'll see what happens with those options. The stock is severely shorted right now, but hey, if shorts did cover on their short positions, that means the stock's probably going higher over the next couple of weeks, guys. So that is going to do it here in this video. Hit that like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. You guys have a great rest of your day, and I will see you in the next one.